What I'd like to do for you today is two things, really. One is I'd like to give you an outlook for the 2006 economy and beyond. But more importantly, I'm sure you've probably heard economic forecasters before, and frankly, they're a dime a dozen, and half the time they're wrong. What I'd really like to do for you, which is I think a little bit more interesting, is talk about some of the strategies and tactics you as HR professionals can use in terms of managing the business cycle. And what I've found in my research at the Navarro School is that this is really one of the most overlooked aspects of management for companies. And it's not just the fact that HR professionals may not look at what's going on with the business cycle. It's across the board, whether it's marketing, whether it's the OR people, whoever, the finance people. So these are the two things I want to do. So let's talk about 06. 06, by large consensus, is going to be a good year. We've been growing in this country about 3.5% to 4% annually in terms of the gross domestic product. What does that statistic mean? That statistic means that that's pretty darn good growth. Historically, prior to the 1990s, if we did 3% a year, that was pretty good. We got really spoiled in the 1990s because we were hitting 4 and a little more than 4% annually. But right now, we are in what Alan Greenspan called a virtuous cycle, where we got less than 5% unemployment in the country, which means we're at full employment. We're hitting almost 4% on the growth rate. And guess what? Inflation is almost non-existent. I mean, you can't do better than that. Well, here's the problem. What we're seeing is that we're likely to decelerate as we move through 06. And the problem is basically the housing market. We have long-term interest rates creeping up a little bit. And since 9/11 and in the aftermath of 9/11 and the collapse before that of the stock market, we've been basically running this economy on your housing ATM. Now, here's my question for you. How many of you have refinanced your home in the last 4 years? Raise your hand. Oh, look at that. 100. How many haven't? Why not? Okay, but the litmus question really is, now, I mean, everybody who refinanced your homes, raise your hand. Okay. Now, keep them up there. If you took some or most of that money and actually spent it. Oh, I don't believe that a bit. Not if you're like the rest of America. 2/3 of America right now are using their house basically as a cash machine. Now, that's been great for the economy because what that does basically is allows us to go in and consume, and consumption is 2/3 of the gross domestic product, and off we go. But we did an analysis last week of the numbers, and it showed that if you took away the housing ATM, we would have had negative growth as we did in 01, but it would have even been worse. But we would have had negative growth in 02, and we would have had GDP less than 1% in 03, 04, and 05. Think about that. What the housing market has done, basically, is to replace the wealth and spending habits that we enjoyed in the 90s from what? The stock market. So the problem is that as interest rates go up, the housing market cools, the refi market goes away, some of that spending goes away. Now, a lot of economists are saying, don't worry, be happy, because businesses have a lot of money on their balance sheets. You may have noticed that a lot of businesses aren't investing a lot in America anymore, which is why they have a lot of money on their balance sheets. But the thinking is that they've just been waiting for things to get better, and that this will be the time when capital spending will begin in earnest. And in the best case scenario, what you'll have as the housing tapers down, the capital spending from business will taper up, and we'll stay kind of at 3.5%. Probably we'll get through the year pretty good. But the question is, what happens beyond? And this is where I want to work with you to do a little bit of analysis, talk a little bit about what can go wrong. First of all, the housing market may not just go slowly and kind of settle in. It could actually turn into a rout in that market. What's the problem here? Well, first of all, let me ask another question. How many of you have adjustable rate mortgages? Oh, this is a brilliant audience. See, this is clearly not America, okay? All right? You people are the 99th percentile in terms of intelligence, economic intelligence in America, right? Because a huge amount of people are running these adjustable rate mortgages. You know the drill. You go in, no money down, you take the adjustable because it's a little bit less than the fixed. You can just make your payments as it is. And the problem is going to be that if interest rates start to creep up in the arms, which they already have, people might not be able to meet their payments. They'll start walking away. Now, the other thing about the housing market is about a fourth of them are flippers. A fourth. Think about that. A fourth of the people in the housing market are flippers, speculators. A lot of them own more than one house. So you can kind of see the problem. And of course, there's the housing price thing. I won't tell you the long portion of the joke, but let me just tell you the punchline and see if it makes you laugh. I always wanted to live in $1 million home. I just didn't think it'd be this one. Yeah, you get it. You get it. Now, let's talk a little bit about how not only the housing market could unravel, but interest rates could also move up and bring capital investment down as well. And we have to kind of be a little bit honest with ourselves here in America about how we've been enjoying life post 9/11. What we've been doing basically is enjoying what I would describe as the single largest double dose of fiscal and monetary policy in our history. A little academic jargon there. What do I mean by that? Fiscal policy is simply what the government does in terms of spending and tax policy. And what this administration has done basically with its tax cuts is introduce what's called a structural budget deficit into our economy. And what I can tell you is that a structural budget deficit is worse than just a regular budget deficit. A structural budget deficit means that even if you're at full employment, the economy is going great, the welfare and unemployment payments are down, you still have a deficit. What does that mean? It means you're spending more than you're earning. And that's basically what we're doing. And it happened not just because of the tax cuts, of course, because all the expenses we have in Afghanistan and Iraq, the war on terrorism, and we need to spend that money. But it's put us in a situation where when you add tax cuts to that, we're in what we in economics like to call an unsustainable equilibrium. What it means is that as we keep going to the bond market well, as the government, to finance that deficit, at some point the concern is that that's going to drive up long-term interest rates. Hasn't happened yet. Now the question is, why hasn't it happened? One word. Anybody want to know? Want to say what that word be? China, thank you. Boy, this audience is great. Yeah. I don't know if we can teach them anything at Mirage. They already got it down. China. Now, what she means by that is that as fast as the Treasury is pumping out bonds, the Chinese are buying those bonds with our money that we spent in Walmart the month before. And what that does is that the Chinese demand drives bond prices up and yields down, and that keeps everything kind of okay. Now, the other problem with that, of course, is that we're getting trade deficits now, that we're cruising along at a cool $50 billion. I mean, that was like no big deal. Now they're up to 65 and 70. And we are essentially in what Larry Summers, the president of Harvard and former Secretary of Treasury, said, a balance of financial terror. Meaning that the Chinese don't want to stop buying our bonds because they need it to keep their currency low, to keep people employed in their country to keep political pressures